Welcome back to the channel, everyone. Today, we're diving into a topic that has been a hotbed of discussion among investors of all levels: the comparison between investing in startups and established companies. Both paths have their merits and drawbacks, and as a financial expert, my goal is to provide you with a nuanced understanding that encourages reflection and analysis on your part. Let's start by addressing liquidity. When it comes to established companies, particularly those that are publicly traded, liquidity is generally more favorable. You can buy or sell shares with relative ease on the stock market, allowing you to access your funds quickly if needed. This is especially advantageous during times of financial uncertainty when quick access to cash can be crucial. Conversely, investing in startups often means locking up your capital for a significant period. Startups are typically not publicly traded and may take years to mature into a profitable venture. During this time, you may find it challenging to liquidate your investment should the need arise. The trade-off here is the potential for high returns. While it may take longer to see those returns, the payoff could be significant if the startup succeeds. Now, let's consider accessibility. In recent years, investing in startups has become increasingly accessible thanks to platforms that allow everyday investors to participate in funding rounds. You no longer need to be an accredited investor or have deep pockets to get involved in this space. On the other hand, established companies are also accessible. After all, you can invest in blue-chip stocks with minimal capital via fractional shares or through ETFs. However, while both options are accessible, they cater to different types of investors. Established companies often appeal to those looking for stability and less volatility in their portfolios. In contrast, startups attract those who are willing to embrace risk for potentially higher rewards. The question becomes, where do you see yourself? Are you someone who thrives on excitement and uncertainty, or do you prefer a more predictable investment landscape? Next up is profitability. Established companies often come with historical performance metrics that can help you gauge potential future earnings. They usually pay dividends as well, providing a steady income stream even during market downturns. Startups, however, present a very different picture. They often reinvest profits back into the business for growth rather than distributing them as dividends. While this could mean no immediate returns on your investment, the potential for explosive growth exists if the company captures market share effectively. But let's not forget about risk, the critical factor that weighs heavily in any investment decision. Investing in established companies does come with risks. Market conditions can fluctuate unexpectedly, affecting stock prices regardless of a company's fundamentals. However, these companies tend to be more resilient due to their established market presence and revenue streams. Startups inherently carry higher risk levels due to their nascent stage in the business life cycle. Many startups fail within their first few years of operation due to various challenges such as competition, mismanagement, or inadequate funding. This means that while the potential rewards might be substantial if you pick a winner, there's also a significant chance that your investment could go to zero. Finally, let's touch upon psychological factors that influence our decisions as investors. Investing in established companies can evoke feelings of security and confidence because of their proven track records. They represent familiarity and reliability, a comforting presence in an ever-changing market landscape. On the other hand, investing in startups might ignite feelings of excitement and anticipation, but can also lead to anxiety given the uncertainties involved. The thrill of being part of something innovative can be intoxicating. However, it requires a strong mental fortitude when things don't go as planned. As we reach our conclusion today, I encourage you to reflect on these aspects: liquidity versus accessibility, profitability against risk, security compared with excitement. Each path offers unique opportunities and challenges that deserve careful consideration based on your financial goals and risk tolerance. So which option resonates more with you? Are you leaning towards established companies for their reliability and liquidity? Or does the allure of startup investing capture your interest despite its inherent risks? I'd love to hear your thoughts in the comments below. What factors weigh most heavily on your decision-making process? Let's engage in this dialogue together as we navigate the complex world of investments. Don't forget to like this video if you found it helpful and subscribe for more insightful discussions on finance.